You're missing out on boosting your credit score if you're not paying off your credit card on this date. Knowing the best day to pay off your credit card could save you money and potentially improve your credit score tremendously. This is about timing, strategy, and taking control of your finances. No fluffs, just actionable steps you can take today. First, let's go over why timing matters on credit card payments. Your credit card has two key dates, the statement date and the due date. Most of us focus on the due date because that's when you need to at least make the minimum payment to avoid late fees, and it's usually 21 days after your statement date. But here's the thing, the statement date is just as important, if not more so, when it comes to your credit score. The statement date is the day your billing cycle closes. It's also when your credit card issuer reports the balance to the credit bureaus. And this reported balance determines your credit utilization ratio, which is a huge factor in your credit score. Now, there are 5 aspects that determine your credit score: credit utilization, on-time payments, credit history, credit mix, and hard inquiries. Credit utilization accounts for about 30% of your total score. Credit utilization is the percentage of your available credit that you're using. For example, if you have a $10,000 limit and a $5,000 balance, your utilization is 50%. Keeping this ratio below 30% is crucial, and ideally under 10%. Now, does this mean that you can never have a balance over $1,000 or 10% if your credit card limit is at $10K? No, you can have $5,000 on your credit card, but you just need to pay it off to at least 30% utilization rate before your statement date. 35% of your credit score is making on-time payments. That's it. So in order to not get late fee charges, set up auto payments to pay the minimum balance at least. Now, if you happen to be a day or two late on paying your card that month, don't worry, just pay it off as soon as possible. It won't really ding your credit score that bad. The other 35% is broken down into credit history, so how long you've had a credit card. If you don't use your very first card, do not close it. Just charge an inexpensive subscription for $10 and set up auto payments. 10% is your credit mix, so the different types of credit you have, so credit cards, a mortgage, a car loan. And the last 10% is a hard inquiry or pull when you have to have a credit report. These fall off your score after 2 years. So the final answer, paying off your credit card a couple days before the statement date ensures you have a lower balance that's reported to the credit bureaus and potentially boost your credit score. If you want to fully optimize your score, paying your card in full a couple days before the statement date is key. Now, you might wonder, why not pay my credit card off at the end of each week? While it's great to pay off your balance, timing does matter. If your balance is still high on the statement date, that's the number reported to the credit bureau no matter how many payments you made earlier in the cycle. And also with timing, if you know your max spending limits for the month, you're already one step ahead in terms of controlling your finances, so you don't need to be in your bank app every day or even every week. To pay off your card, either set up automatic payments to pay in full a couple days before your statement date, or pay what you can to get your debt as low as possible, again before the statement close date. However, if you're the type of person who pays your card in full at the end of each week, and you have no debt on it, meaning a balance of 0 coming with statement close date, your utilization score will be 0%, because the report to the credit bureau shows you have used none of your credit limit. For this particular scenario, if you know you can pay your credit card off in full and you have everything paid off pretty much before the statement close date, instead of having your utilization rate be 0, just save a little bit, maybe around 10%, and pay the rest off like a day after. That could potentially help your credit score increase because, again, utilization is such a big part of it. So let's fact check real quick. Does paying off your credit card before the statement close date actually improve your credit score? The short answer is indirectly yes. When you pay before the statement date, your reported balance is lower, reducing your overall credit utilization ratio. Since utilization makes up about 30% of your total credit score, that can have a huge impact. But remember, just paying by the statement close date is just one piece of the puzzle. Consistently paying on time, keep your balances low, and making sure you have a credit history, also crucial. Here's what you can do right after this video to put this into practice. Number 1, find your dates. Check your credit card account for your statement date and your due date. Number 2, set alerts. Schedule reminders a few days before your statement date to pay off your balance if you can't pay it off in full. Number 3, automate payments. Set up automatic payments for at least the minimum amount by your due date to avoid late fees. Set up automatic payments to pay off your card in full if you have that option. Number 4, monitor your utilization. Keep your reported balance under 30% but under 10% of your credit limit for the best results. By focusing on your statement date, you're not just paying off your debt, you're taking control of your financial well-being. Timing your payments could make a difference in your overall credit score and financial stability. Start paying attention to your statement date, pay your balance in full if you can, and keep your utilization low. If this video helped you, share it with someone who also wants to level up their financial game. And remember, managing money is about strategy, not stress. If you want to improve your money management skills and build your wealth, be sure to check out other videos on my channel as well.